Good afternoon. My name is Courtney Conrad. I'm a partner in the Trust Estates and Legacy Planning Group here at Lathrop GPM. On behalf of myself and our presenters, Phil Johnson and Cheryl Morrison, I'd like to thank you for spending your lunch hour with us today. Before we get started, I'm going to just take a couple of minutes to share with you a little bit about Lathrop GPM and the Trust Estates and Legacy Planning Group, as quite a few things have changed since the beginning of the year. Lathrop GPM was created on January 1st of this year as a result of a merger of two very old law firms, over 100 years old. Lathrop Gage was established in Kansas City in 1873, and Gray Plant Moody was established in Minneapolis in 1866. So Lathrop GPM was created on January 1st, 2020, as a full-service law firm with close to 400 attorneys, over 14 offices that range from Boston to LA. The Trust Estates and Legacy Planning Group is comprised of 37 attorneys across 6 offices, specifically in Minneapolis, St. Cloud, Denver, St. Louis, Kansas City, and Overland Park, which makes our group one of the largest trust and estates practices nationally. In fact, in the aggregate, the attorneys in the Trust Estates and Legacy Planning Group at Lathrop GPM have close to 1,000 years of experience, which is pretty amazing. We're pleased to share some of our expertise with you today. So with the markets down and interest rates at all-time lows and so many unknowns ahead with this being an election year, there may be no better time to engage in wealth transfers and charitable planning, as Phil Johnson and Cheryl Morrison will explain to us today. Phil Johnson is a partner in the Trust Estates and Legacy Planning Group in the Kansas City office. His practice runs the full gamut of trust estate planning, administration, and litigation, and he has a particular focus in sophisticated estate planning for high net worth clients, and particularly those facing gift and estate tax implications. Cheryl Morrison is a partner in the Trust and Estates and Legacy Planning Group out of our Minneapolis office. Like Phil, Cheryl's practice covers all aspects of trust and estate planning, administration, and litigation, but Cheryl has a particular expertise in philanthropy, specifically in creating, qualifying, and the administration of not-for-profit and tax-exempt entities. So we've got some very credentialed speakers today. Before I turn it over to Phil to get us started, I want to note a couple housekeeping items. The first is we will welcome any questions from the participants during the presentation. So we will stop periodically throughout the presentation, and there's a chat feature on the Zoom that you can type in your questions, and then I will present them to the presenters intermittently throughout the program. And in addition, we'll have some time at the end to address some of those questions as well. We'll go through and address as many questions as we can with the time allowed. The other thing to be aware of is that the webinar is being recorded and will be available on our website tomorrow, along with a copy of the slides. So you'll each receive a follow-up email tomorrow directing you to the link in our website where you can access that information for your additional resource, or to feel free to forward on to anybody else that you think might have an interest in the topic. So with that, I'm going to turn it over to Phil Johnson to get us started. Phil?
Thanks, Courtney. Hi, everybody, and welcome to the Twilight Zone. It's hard to believe that all this has happened so quickly. Just 2 months ago, the markets were at all-time highs, and the economy was humming along, and then the virus hit, and here we all are sitting at home. But what's the landscape today? The markets have gone down about 20% today from their all-time highs. They were down over 30%. The markets could go down more depending on the news about the virus and the economy. The interest rates that we use in estate planning in April had fallen to almost historic lows, and then we just got the May rates yesterday, and starting in May, the interest rates used in estate planning will be the all-time lowest rates. With everyone having gone home, the economy is likely going to suffer a historic contraction. JP Morgan is now predicting a 40% contraction of GDP in the second quarter and unemployment over 20%. On top of all that, we've got an election looming in November, and typically a soft economy has a big impact on an election and often leads to a change in political control. That could have a big impact on estate planning because the two parties have much different pictures of what the estate tax should look like. The current estate gift tax exemption is $11,580,000, and the tax rate is 40%. That exemption, without any further change in the law, is scheduled to expire after the year 2025. When it does, it's supposed to fall back to half of what it is then, and the exemption is adjusted every year for inflation. So absent a change in the law, we're probably looking at a $6 million exemption starting in 2026. The Democrats have a much different idea of what the estate tax law should look like. They have proposed an exemption of only $3.5 million, with tax rates ranging from 45% to 77%. The Democrats are also proposing to eliminate what's called the step-up in basis, which eliminates any built-in capital gain at death. But also like to take away a lot of the techniques that we use that are very effective at transferring wealth and reducing or avoiding estate and gift tax. So all of that sounds pretty bad, but in our world, it actually presents opportunity, and depreciated asset values combined with low rates, it can actually be the perfect storm for transferring wealth. So what should someone with wealth do? And with the world crashing down around us, it probably sounds very counterintuitive for someone to tell you that the right move is to give assets away. But that actually could be the right thing to do. And the focus should be on markets have gone down. We actually want to try to get appreciation out of your estate. When the markets come back, that happens outside of your taxable estate instead of happening inside your taxable estate. And if the idea of giving away a lot of assets in the middle of a crisis causes heartburn, there are ways to structure the transfers and the gifting that you wouldn't necessarily lose access to the funds that are gifted, even though we've shifted them from being in your estate to outside of your estate. Next slide, please. So what are some of the things that can be used to transfer that appreciation out of your estate? The first is an installment sale to a trust that's known as a defective grantor trust. A defective grantor trust is one over which the grantor retains certain powers that cause the grantor to continue to be treated as owning the assets, but for income tax purposes only, not for estate and gift tax purposes. And that has a couple of effects that are useful in estate planning. One is, even though the grantor doesn't own the assets anymore, the grantor still has to pay the tax on the income of the assets, which is the equivalent of a tax-free gift every year. And the second thing, because the grantor is still treated as owning the assets, the grantor can move assets back and forth between himself or herself and the trust, and that is not a taxable event. So normally when you sell assets, that's going to trigger any built-in capital gain, but you can sell assets to a defective grantor trust without triggering that gain. So the trust can be set up for kids and their kids. You can also include your spouse as a beneficiary of a defective grantor trust. Some people would argue that the grantor could be trustee of the trust, which is appealing for a lot of people because they continue to control the assets that are in the trust. But that probably adds a little risk into the transaction. It's better if the grantor is not the trustee of the trust. Often it's the spouse or the kids. Next slide, please. So, how is an installment sale, back one, there you go. How is an installment sale structured? So the trust to which the assets are sold has to have equity, similar to a down payment on a house. And the accepted ratio is the equity should be 1/9 of the value of the assets that are sold to the trust. So to get the equity, you can either make a gift to the trust that will provide the equity, or some people have existing defective grantor trusts that already have substantial value and have plenty of equity to support an installment sale. So the assets are sold to the trust in exchange for a note. The note can have different terms. There's different rates depending on the length of the note. In April, the rate for a note of up to 3 years is 0.91%. A note for 3 to 9 years, the rate is 0.99%. And a note exceeding 9 years, the rate is 0.44%. Typically, a long-term note would be 15 years or so. As I mentioned, we just got the May rates, and those rates are quite incredible. So the rate for a note of up to 3 years is 0.25%, almost free money. The rate for a note of 3 to 9 years is 0.58%, and the rate for a note over 9 years is 1.15%. So you can get a 15-year loan for almost 1%. So the note is interest only for the term of the note. You have to make your interest payments every year, and the note can be prepaid at any time. And so once you've made the sale, the assets have appreciated inside the trust, hopefully, then you can either let the note run and pay it off at the end of the term, or because you can prepay the note, let's say the market quickly rebounds, then you could simply get your original money back and leave the appreciation in the trust. It would then be outside of the taxable estate. Next slide, please. So here's an illustration of how an installment sale to a defective grantor trust can work. Dick and Jane had $30 million of assets just a couple of months ago, and now their assets are down to $20 million, which is less than the combined estate tax exemption of a little over $23 million. Dick creates a defective grantor trust. Jane and their descendants are the beneficiaries. Jane is the trustee. Dick gives $2 million of the 20 to the trust and sells $18 million for a 9-year note with a rate of 0.99% in April and 0.58% in May. After 3 years, everything has settled down. The markets have come back. The $20 million that was transferred to the trust has grown back to its prior value of $30 million. Dick decides he wants his original money back, so the trust pays him back the $18 million on the note, and now there's $12 million that's left in the trust that is now outside of the taxable estate of both Dick and Jane. So they've got $18 million. If they need more, because Jane is a beneficiary of the trust, they would have access to that extra $12 million if it's ever needed. Next slide. A defective grantor trust can be designed as what's called a generation skipping trust. And if it is, the way to do that, you would have to allocate, Dick would have to allocate $2 million of his generation skipping tax exemption to the gift that he made to the trust. If he does that, then that $2 million plus the $12 million of appreciation will be sheltered from estate tax in Dick's generation, his kids' generation, his grandkids' generation, and so on down the line, as long as the money stays in the trust. And so what if Dick enters into this transaction, sells his assets, gets a note back, and there is a political turnover in November, and the Democrats pass a new law changing the exemption from 11.5 million to 3.5 million. There's a provision in the current law called the no clawback provision that if you make a gift and use your $11.5 million exemption before the law changes, they can't take that away from you later. And so a simple way to make that gift and claim that extra exemption, if that does happen, would be Dick could simply cancel part of the note up to his exemption amount, and then that would constitute a gift that uses that exemption. So it would be a very simple way of using the exemption. And so the illustration assumes a pretty simple transaction, just using liquid investments, publicly traded stocks, those kinds of assets. But a closely held family business could also be used in this kind of a transaction. And given the uncertainty about the economy, that would probably affect the valuation of a family business as well. So it could also be a good time to transfer the family business. And the last note there, so the biggest risk of an installment sale is, you know, we're down 20% in the market. What if we're not at the bottom? What if someone enters into an installment sale and the market goes down another 30%? Well, you can't just ignore the note. You know, it still has to be paid at its original value. And if that were to happen and the market doesn't recover by the time the term of the note expires, it still has to be paid. And so at least $2 million were gifted to the trust. That would have to be used to pay back the note. So that would waste that exemption that was used on the gift. Or if assets were sold to an existing trust that already has a lot of value, that would have the effect of pulling the assets that were in that trust back upstream into the estate, which would not be a good result. So if we think we're close to the bottom, an installment sale could work great. If we've got some more room to fall, then something else might be considered. Next slide, please.
Phil, do we want to
So that
stop
leads-
here and give our participants an opportunity to ask some questions?
Yep, sure, go ahead.
If to our participants, if we have any questions, please use your chat feature to ask them. We do have one question. You mentioned that interest rates are going down in May. It seems like pretty significantly. Does it make sense to hold off on doing planning to see where interest rates go in future months?
Well, that depends. Depends on what happens with the market. So it's far more important to catch the dip in the market than it is to catch the dip in the rates. And so if you wait until May and rates have gone down maybe half a point on the rate that's used in the transaction, but the market has come up 10%, then that's going to be counterproductive. So it's far more important to try to catch the market at a lower point than it is to try to catch the rates at a lower point.
Okay. We don't have any other questions at this time. Thanks, Phil. Go ahead.
Okay. So if you're worried about the market going down more and a sale to a trust for a note could be counterproductive because the note still has to be paid, an alternative is something called a grantor retained annuity trust, which is referred to as a GRAT for short. And a GRAT is relatively simple. So the grantor transfers assets to the GRAT in exchange for an annuity that's paid every year over the term of the GRAT. And most GRATs are what's referred to as a zeroed out GRAT, which means the grantor at the end of the GRAT has received back everything that he transferred to the GRAT, plus whatever the applicable interest rate is when the GRAT was funded. And so because you're getting back everything that you put in, that's considered not to be a gift, and that's why it's called a zeroed out GRAT. The current GRAT rate is 1.2%. That rate is going down to 0.8% in May, which is also an all-time low. So all you have to do for a GRAT to work, you have to beat the 1.2% rate today or 0.8% next month. Any appreciation over that amount is going to leave the taxable estate and go on to trust for the family or to descendants, tax-free. When a GRAT terminates, there's a couple of ways you can structure how the assets will go. Often you just simply have it go out to children, or you could choose for whatever's left in the GRAT to go into a further trust that can benefit the spouse and descendants. The grantor can be trustee of a GRAT during the term. There is no risk in doing that. So how does a GRAT work? Back to Dick and Jane, they had 30 million, it's now down to 20. Dick sets up a 2-year GRAT with himself as the trustee. He puts the 20 million in the GRAT. The applicable interest rate is 1.2%. After 2 years, the 20 million has grown back to 30 million. Dick receives 2 annuity payments, one after the first year, one at the end. Those payments total a little over 20 million. $7.5 million remains in the GRAT. So Dick ends up getting back his original 20 million, about another 350,000. 7.5 million leaves Dick's taxable estate and either goes on to kids or maybe to a trust for Jane and the descendants. Jane is a beneficiary of the trust that receives the 7.5 million. So if Dick and Jane ever need that money, they would have access to it. So, as I mentioned, a big benefit of a GRAT is that there's no downside risk with the GRAT. If we're not at the bottom and values keep going down and the GRAT doesn't work, you just take back whatever's left and start over. There's no note that has to be repaid. A GRAT does have some disadvantages compared to an installment sale. A GRAT is not a generation skipping transfer, so the $7.5 million of appreciation that accrued inside the GRAT, it will leave Dick's estate, but it would be included in the taxable estate of future generations. So I call an installment sale a multiple generation transfer. I refer to a GRAT as a one generation transfer. For a GRAT to work, Dick has to survive the term of the GRAT. If you don't survive the term, then the GRAT fails and everything that's in it is included in your taxable estate. And a GRAT annuity payments are amortized. They're not interest only, like with an installment note. And therefore, with every annuity payment that's made, you're putting assets back into the taxable estate, and they then start appreciating inside the taxable estate instead of continuing to appreciate outside of it. Another potential issue with the GRAT is generally a GRAT has to have at least a term of 2 years. And so if you commit to assets being in a GRAT for that long, and there is a political change in control, the laws change, you have to make a gift and use your exemption before it expires, but your assets are stuck in the GRAT, that could present potential problems. Last thing, just like with an installment sale, you could transfer stock in a closely held family business to a GRAT and do the same thing, hopefully catch a lower value and then have the value of the family business grow back outside of the taxable estate. That can be a little more complicated because you're going to have to transfer interest back to the grantor every year and probably have to get the company valued every year that the GRAT exists.
Phil, we have a question. Yeah,
Okay.
we have a question from one of the participants inquiring as to whether the annuity payment is treated as ordinary income.
It is, well, the annuity payment itself is not treated as anything because a GRAT is also a defective grantor trust. And so all of the income of the GRAT is taxable to the grantor during the term of the GRAT. And so, you know, if part of the income of the GRAT is ordinary income, then that would be taxable to the grantor. But the
Okay.
annuity payment
We don't have any.
itself is disregarded.
Thank you. We don't have any other questions at this time.
Okay. Well, I'll just close with a couple of quick thoughts. You know, the idea of having this webinar and trying to get it set up quickly was to try to catch a dip in the market and see if that can be used to move appreciation out of someone's estate. But if a family is interested in doing a bigger transfer, you know, maybe transferring the family company or something like that, then, you know, this could also present an opportunity to do that as part of a longer term plan that might use the exemption before it expires. And the last thing I would say, you know, we've done this once before back in the financial crisis where the Dow dipped all the way down to 6,500, and the families that acted during that time and took advantage of that, you know, the Dow has now grown back to about 23,000. And so those transactions did very well.
Thank you. Cheryl?
Yes, thanks, Phil, and thanks, Courtney. I want to talk about another theme that we're seeing in these times of the pandemic. Individuals are asking, how can I help? And for nonprofits, they're facing the question of how can we find help and how can we find support at a time when many nonprofits are being called on to step up efforts to relieve stresses in the community. I'm going to talk about some charitable strategies that just happen to be more timely now because of where we find ourselves in the economy these days. Phil has already touched on some of the trends that we're experiencing right now, with asset values being lower, interest rates being lower, and I want to cover some strategies that react and work well in a situation where those economic factors are taking place. First of all, though, I want to talk just about a couple of the changes that came about as a result of the CARES Act that, that promote charitable giving during these times. As a quick little refresher, the 2017 Tax Act had a couple provisions that affected charitable giving that relate to itemized deductions and the standard deductions. So itemized deductions were limited. The charitable deduction still remained as a potential deduction. There was, limitations instituted on the state and local tax or SALT deductions that are available, and that act raised the standard deduction higher for all classes of filers. As a result, the changes in the 2017 Tax Act really had the effect of having fewer itemizers who were filing returns, and the effect of that is that some people stopped their charitable giving if they couldn't itemize and take the deduction for it, and instead could just take the standard deduction and not take into account charitable deductions. The CARES Act that just came out seeks to address those non-itemizers by giving a universal deduction referred to as an above-the-line deduction of up to $300 per eligible individual for making charitable gifts in 2020. That change is limited to 2020. It's limited to cash gifts given by individuals, and it's limited for gifts to certain kinds of charities, which excludes supporting organizations, donor-advised funds, and private foundations. This is for non-itemizers so that they can obtain some tax benefit by making these kinds of charitable gifts. And the hope is that that incentivizes those folks to be doing more giving in 2020. Now, $300 is not, is not what was hoped for in this kind of relief or benefit, but that's what it is. And so that's something that non-itemizers can be taking advantage of here in 2020 to help with making gifts to nonprofits who are out there on the front lines trying to address needs in the pandemic. Slide, please. So back one, I think. There we go. The other change that the CARES Act made was that it increased the cap, if you will, on cash gifts. Previously, the 2017 Tax Act raised from 50 to 60% what's called the contribution base. And the contribution base is roughly adjusted gross income reduced by other donations during the year. So for cash donations, there was a 50% cap, and then the 2017 Tax Act raised that to 60% that donors could give and still deduct. And these are itemizers that we're talking about here. For 2020, that cap is now 100%. Again, it's limited to cash gifts, it's limited to 2020, and it's also limited to that same class of charities who really are sort of viewed, I think, by the IRS as being charities out there who are on the front line. The money's going to get deployed to address current needs. It's not going to be held. And so that's really, I think, the preference around the public charities. Although the concept of supporting organizations not being included is a little baffling to a number of us. In any event, so this provision is designed to incentivize cash giving in 2020, really specifically as a result of the pandemic. The law also changed the corporate limits, raised them. So for cash from corporations, from 10% to 25% as that cap. And for food inventory donations, from 15% to 25%. So those, again, all of these changes are designed to incentivize giving to, address needs here in the pandemic in 2020. So I think with that, let's see, let's move on to the next slide. I just want to touch on, it's sort of tried and true charitable giving advice, if you will, that donors should think about giving appreciated assets to charities. And the reason for that is because there's, in the typical circumstance, for long-term appreciated property, there's a deduction available at the fair market value of the property, and yet the donor does not have to recognize any built-in gain. So there's sort of this double tax benefit to giving appreciated property. Well, in today's market, it may be hard to find appreciated property, just given what's happening in the economy and property has been devalued. It may be possible to still find some of that, and that a donor would be willing and interested in giving those kinds of assets away. Of course, charitable deductions are lower if the value is lower, so that's also a trade-off. And another thought about this tried and true advice is that at times when the market is so volatile, there can often be a delay between when the donor tells the donor's broker to transfer stock to charity and when the charity receives it. And the important valuation date is when the charity receives it. So volatility can mean that there's a difference between what the donor thinks he gave and what the IRS recognizes as the value he gave. There could be other property out there that is also appreciated and might be ripe for still doing this kind of contribution even in today's world. So Courtney, let's change the slide again. Another sort of popular and tried and true strategy out there is an IRA charitable rollover or a qualified charitable distribution. This is available for donors who are over age 70 and a half and up to $100,000 per year. The donor can directly from the IRA to a public charity, again, not a donor advised fund or private foundations, an amount out of the IRA up to that $100,000. The benefit of that is that while the donor does not get a charitable deduction for that, really the money didn't go through the donor's hands, but the donor also does not recognize income. So it's kind of a neutral with respect to income tax. The other benefit, though, was that if the donor was required to take distributions out of the IRA by the IRA required minimum distribution rules, then this kind of transfer would qualify as all or a portion of the RMD that donor had to take. So it had that, sort of double benefit. In 2020, however, the CARES Act does suspend the necessity of making RMDs, so that benefit would not be available for donors looking at this kind of strategy to support their favorite charities. However, it may still be useful for non-itemizers who are looking for ways to help. If they're interested in making a gift out of their IRA, a non-itemizer is not going to be concerned about the charitable deduction anyway, because they're not going to itemize. On the other hand, they may want to send some money out to their favorite charities, and they would still get sort of that neutral income tax treatment. They don't have to show this income on their return. For donors who might bump up against AGI limitations on gifts, so gifts of stock or real estate or something where the AGI limitation is still lower, donors can exceed that limitation by making the gift out of the IRA because that does not implicate the AGI limitation. Finally, for a donor who might want to make an IRA qualified charitable distribution gift but wants to do more than $100,000, remember the cap is $100,000, and so that donor can get around that this year by taking the cash out of the IRA and then making a cash donation directly. That would count as income to the donor in the amount of the distribution from the IRA, but remember the donor gets 100% deduction this year for gifts of cash to qualified charities. So it would be largely an offset this year. I think with that, yeah, go ahead.
Yeah, I'm sorry. We do have a question. Going back to the non-itemized charitable deduction of $300, the question is whether that is per taxpayer or is that for a married couple filing jointly?
That is an interesting question, and I just had a conversation with a client here the other day about that. And what's interesting is I have heard two answers to that question from very very smart sources. So my view, and when I look at, we spent some time looking at the language of the act, and then sort of influencing that with what happens with other types of charitable gifts. For a married couple filing jointly, each couple might make different contributions, charitable contributions, and yet the couple gets to take all of those. It's not as if they just can take one of them. They can take the deductions or the gifts made by both individuals. That leads me to think that this $300 is per taxpayer, so that a married couple filing jointly could take, $300 for each of them. Now, I don't know that there's an answer to that out there, and as I say, I've heard two different answers, but that would be my view, just sort of trying to understand how the IRS thinks of people who are filing jointly.
Okay, thank you. There's no other questions at this time.
Okay, great. Let's move on then. And so Some of what I want to talk about now is related a bit to what Phil covered. So some of the concepts are the same in that, you know, there's this notion for estate and gift tax planning that, you know, donors might want to take action now that has to do with lower values of assets, fear that the exemption might change sooner than we think it might change at the federal level. It's also important to think about whether your state might have state and gift tax laws that you're thinking about as well, and exemptions there. But this idea of getting the appreciation out of your estate and doing it when assets are valued lower, and also in an environment where the interest rates are low, and that is actually favorable to a number of charitable planning ideas in which the donor or the donor's family benefits from the gift, but charity also does. And so let's go to the next slide, and I want to talk about one of these. So a charitable lead trust is a trust that looks a lot like a GRAT in many ways. The remainder interest goes on to the donor's family. The donor's family could be in the form of, you know, another continuing trust of some sort, or outright, as Phil mentioned. If it does go on to other generations, there's a particular type of charitable lead trust that is more useful and workable when you're looking at generation skipping planning using a charitable lead trust. And that's something called a unitrust or a CLUT, charitable lead unitrust. In a CLUT, that's the tool of choice for using a charitable lead trust where you're ultimately benefiting generations farther on than your children. A charitable lead annuity trust is a trust in which the amount paid to the charity is fixed. When the trust is created, it's a fixed dollar amount. It is possible to draft in variations on that, but it's otherwise fixed, whereas a unitrust moves the payment of the charity based on the value of the assets. So as a result, a unitrust is not very sensitive to income or to rate changes, whereas the annuity trust is. What's important about this strategy is that the lead interest, the immediate stream of payments, goes to charity. The remainder goes to family. In valuing the present value of those two interests, that IRS 7520 rate that Phil referred to is used. And so when rates are lower, the value for tax purposes of the amount going to family at the end of the day is also going to be lower. And the value of the amount going to charity is at the front end is going to be higher. And so I think let's just look at the next slide. And this is just a pictorial view of how this trust and the flow works, where there's the transfer to the trust pays amounts out to charity for the defined period, and then the remainder of the trust goes to family beneficiaries. And so let's talk a little bit then about an example of why this works better now, and move to the next slide to talk about that example. So let's consider the idea of a CLAT that is a 20-year CLAT, and this is an annuity trust, not a unitrust. It pays that 5% annuity amount for that 20 years. If the assets that are transferred to the trust are worth $1 million, that means the charity gets $50,000 per year. In April, the 7520 rate is 1.2%. Again, historically very low, but also think about what's happening in May. For gift tax purposes, and I'll talk about income tax in a second, for gift tax purposes, there's an $884,000 charitable deduction for that stream of payments to charity over that 24 years, or that 20 years, excuse me. The remainder, which is what we're valuing for gift tax purposes, is $115,000 and change. It is also possible, like with a GRAT, to zero out that remainder so that the gift tax is virtually non-existent on that interest. If this trust is created at a time when interest rates are higher, so 8%, that Section 7520 rate, the gift to the family is going to be valued at $509,000, a lot more than $115,000, which is what it's valued at when the interest rate is 1.2%. When you look at what goes to the family, and this is the same thing as a GRAT essentially, is that if the returns in the trust are good, then the family ends up with more assets than what are subject to gift tax. So if the trust generates a return of 5%, it pays out 5%, the family ends up with $1 million. If the trust generates a return of 6%, the family ends up with $1.3 million. And all of that excess over the IRS's assumption of 1.2% is going to go to the family without gift tax on that gift. Next slide. From an income tax standpoint, there is a charitable deduction if the trust is a grantor trust, just like, thinking about the GRAT again, but the donor would have to report that income on the donor's return. Or if the trust terminates or the grantor dies before the trust terminates, then there is a potential recapture of that deduction as well. For a non-grantor trust, there is no income tax deduction at creation, but the trust gets 100% tax deduction for the amounts paid to charity. So some look at that non-grantor trust as being beneficial from an income tax standpoint overall, because the trust is going to get 100% income tax deduction for amounts paid to charity for the duration, not just in 2020 like we have for cash gifts. So a non-grantor trust can be used with the right investments and such to result in better income tax overall. Next slide. Another strategy that is sensitive to interest rates is the gift to charity of a remainder in a home or farm. The donor irrevocably transfers to charity the interest in the property and then retains a life estate. The donor can continue to occupy the property, receive rents from the farm. There is an income tax deduction for that remainder given to charity. And so let's go to the next slide, and I want to just, again, a picture is worth 1,000 words. So this just shows the flow of that strategy. But let's go to the example, which is the next slide. And the next slide shows if the home is valued at $1 million, same 65-year-old donor, that gift of the remainder interest when the Section 7520 rate is 1.2%, is valued by the IRS at $813,000 versus if the interest rate was 8% these days, that would be valued at $318,000. So for a donor looking at this strategy and wanting to maximize the income tax deduction for doing this, now is the time, or May is the time, when that should be considered. Next slide, Courtney. There are also just some other planning ideas that we want to touch on, and credit for the first one goes to my friend Patty Marguerite, who is talking with her clients about looking to their donor-advised funds for gifts. If donors are concerned about taking current funds out of their devalued assets or cash flow, there's lots of money built up in donor-advised funds across the country, and donors, if they have a donor-advised fund, can look to those assets to be making, more extraordinary charitable gifts this year. The donor doesn't get a new deduction for doing that because the donor got that deduction back when they created the fund and funded it. But for many donors, it's maybe not as much about the deduction and more about the help that they're able to give. Also thinking about just using increased charitable cash gifts in this year when we can do it to offset other extraordinary income events like sale of a business or liquidation of a concentrated position, or perhaps converting to a Roth, which is something people are talking about because doing it now when assets are worth less might be the better tax result because there's less tax. So offsetting some of those extraordinary events with larger capital or cash gifts in this year. Next slide. And then just don't forget about some of the future planning, planned gifts. Charities need the money now, but they also need the money later. And so thinking about, still leaving your legacy in the form of planned gifts is not something that should be ignored now. The charitable remainder trust is something also that is apropos to changes made by the Secure Act recently to retirement benefits and what a beneficiary can or cannot do to stretch out and defer tax on those payments. Where the Secure Act has now limited the stretch out to 10 years for retirement account beneficiaries, not a spouse, not a minor child, not a disabled person, but everybody else, that 10 years isn't sitting well with some people. And so a strategy using a charitable remainder trust would allow that account to be paid to the charitable remainder trust at the participant's death. The charitable remainder trust would spread out those payments over the beneficiary's lifetime. And where the CRT is tax exempt, no tax recognition happens at the donor's death, but instead, just over time, that adult child or whoever the beneficiary is would recognize that tax result, and that results in deferral and spreading that out as well. So with that, I think we've kind of just covered the tip of the iceberg here. On the charitable front, the results of the pandemic have really stressed not only the economy, but people and nonprofits. And so charity is really needed more so now than ever. And I just want to stress that, this is not an exhaustive list of the charitable gifts that can be considered. Every donor has their own situation. And so just thinking about some of these ways and then also other ways to support charity during these times. And I think that concludes my remarks.
Thank you, Cheryl. We are coming up right on 1 o'clock. We've got maybe a couple minutes if there's any questions that anybody wants to submit. Otherwise, I, on behalf of myself and everybody in our group, want to thank you all for joining us. And please feel free to reach out to any one of Bill, Cheryl, myself, or anybody else in the Trust Estates and Legacy Planning group. We do have one question that has just popped up, and we've got a couple minutes. So the question is for Cheryl. I work for a scholarship fund, which is not, I'm sorry, I'm not understanding the question.
I see it. I see it there, Courtney.
Okay. Okay.
So Laura asks, she works for a scholarship fund. It's not really essential in, times of the virus and the pandemic. And is it sort of ethical, tactical to ask for gifts now? I've talked to a number of nonprofits, and, kind of everybody's wrestling with, asking for gifts. And, whether it's somebody who's more sort of frontline essential, or whether it's, somebody like you where you're talking about educational things. There's lots of consultants out there saying you should still be asking for gifts. And, you have to think about, obviously, the right tone. If there's some way that you feel more comfortable sort of tying it to, even if it's tangential, to the pandemic, or at least being cognizant of that in your communications, that, your longevity as a nonprofit sort of relies on continued support. And so you can't necessarily just turn off the valve, because you have to keep the lights on and you have to keep doing your mission that you're doing, and the need for the scholarship funds will not go away just because some people might shift their giving to the pandemic. You still will have donors who love what you're doing and want to support you, and you still want to reach out to them. Anything else?
Cheryl, thank you. We've got a couple more questions that have come through, and we're coming up right on 1 o'clock. So I will make sure that these questions get directed to Cheryl or Phil, and we'll get answers to those that have submitted questions that we've been unable to answer in the time allotted. So thank you, Phil, Cheryl. Thank you, all of you, for joining us, and stay well.
Thanks, Courtney.
Thank you all.